welcome to this lesson about the Series 65 exam. Today our lesson is a deep dive into more about economic factors and business information for the Series 65 exam. So today we'll focus on concepts that directly influence markets and investor decision making. These are core macroeconomic elements that every investment advisor must understand to interpret market signals and economic trends accurately. So in today's lesson, we will cover inflation and deflation, interest rates, yield curves, and credit spreads, and economic indicators, including GDP, employment data, trade deficits, and the CPI, which stands for the Consumer Price Index. These topics will show up frequently on the exam, and even more so in real-world portfolio management. So let's go ahead and get started. So the first topic I want to cover today is inflation and deflation. So inflation is the general rise in prices over time, which reduces purchasing power. A moderate level of inflation is normal and often targeted by central banks. For example, in the United States, the Federal Reserve tries to keep inflation around 2% annually in the country. If it's about that, then they're happy. However, if it gets higher than that, then they are going to start looking into things that they can do to get it back closer to that 2%. Now, there are a couple different types of inflation. We want to talk about demand pull inflation and cost push inflation. So first, demand pull inflation. This is when demand outpaces the supply, and then you get inflation. So that's one way that you can get inflation. The other way that you can get inflation is cost push inflation. This is where input costs rise too quickly. For example, wages or raw materials get really high really quickly, and so then the inflation happens as well. And there are many adverse effects of inflation. For one, it reduces the value of fixed income returns. So if you're getting a fixed amount of a return on an investment, if those dollars become less and less valuable, then, well, that inflation is eating away at your investment. So that's bad. It can benefit real assets like real estate or commodities, but it hurts consumers and retirees on fixed income. So the inflation is going to go up, things are going to cost more, but people are still living on the same incomes, especially like retirees. They only get this certain number of dollars every month, and if those certain number of dollars can't purchase as much because of inflation, well, that's a problem. So people are less likely to go out and buy things when everything costs more, and they're going to buy less than they did before. We also then have deflation. So deflation is a general decline in prices, often linked to decreased consumer demand and economic stagnation. So too much inflation is bad, too much deflation can also be bad. So it does increase the real value of debt. It can lead to lower business revenue and layoffs, and it discourages borrowing and investment. So you can see neither ends of that spectrum are all that rosy. So, but why does this matter? Why do you need to know about inflation and deflation? So inflation and deflation can influence interest rates, monetary policy, and asset class performance. On the Series 65 exam, you must understand how inflation impacts fixed income versus equity investments. So a lot of things that you need to know about inflation and deflation. We'll be talking more about those as the course progresses. So next, let's talk about interest rates, yield curves, and credit spreads. Interest rates are the cost of borrowing money, typically set by central banks. For example, the federal funds rate in the United States. So why is this important? Well, they influence a lot of different things. For example, they influence mortgage and loan rates. They influence bond prices, in which case they have an inverse relationship. You raise the interest rate, the bond prices go down, and vice versa. And they also influence consumer and business spending. So a lot of really important things there. Raising interest rates, what does that do when the interest rates are rising? So it dampens borrowing. If it costs more to borrow money, then fewer people are going to borrow money, and they're going to borrow less of it. It lowers bond prices. We just talked about that, where it's at the inverse rate. It's inverse to the rate. And then also it can slow the economy. So if the economy is overheating, there's too much inflation, then you might want to raise the interest rates to help cool that off. But then, on the other hand, what do falling interest rates do? These encourage borrowing and spending, they increase bond prices, and they stimulate growth. So if things are looking down in the dumps, you're in the trough, you might want to lower the interest rates to stimulate the economy to get back on track. So these are just like tools that they have in their tool chest in order to tweak the economy one way or the other. That's why interest rates are important. So let's talk about yield curves for a second. So the yield curve plots the yield or the interest rate of bonds with equal credit quality but different maturities. And there are 3 different types of yield curves. This is a term that you will need to know. So we have the normal or upward sloping yield curve. This is when longer term bonds yield more than short term bonds. This means that the growth is then expected. Then we also have inverted. This is where short-term yields exceed long-term yields. And this often signals a recession. So you see, looking at this yield curve, you can forecast what's going on. And then finally, so we have the ones that are upward sloping, we have the inverted ones that are downward sloping, and then we have flat ones. There's little difference between the short and long-term rates. And this is usually a harbinger of economic uncertainty. So things are kind of up in the air, people don't know what's going on, and so the yield curve goes flat. Another term that you should know are credit spreads. So a credit spread is the difference in yield between a corporate bond, so by a company, and a risk-free government bond, like from the US Treasury, that have the same maturity. So you're comparing the bonds from a corporation, which do have some risk, with a risk-free government bond. So if there is a wider spread between the two, this means that there is a higher risk perception in the market. The people think that things are looking kind of risky out there. If there is a narrower spread between the corporate bonds and the government bonds, that means there's greater market confidence. So this too can be used as a bellwether to figure out how people are feeling about the economy in general. So for example, if a 10-year treasury yields 3% and a corporate bond yields 5%, then the credit spread is 2%. See how that works? So why are these things relevant? So you must be able to interpret these different market signals, such as inverted yield curves, rising spreads, or sudden rate hikes, because these can indicate economic trouble ahead. And so you might want to say, hey, let's hold off on making this big investment until things settle down a little bit, because it looks like things might be a little rocky. All right, next we're going to talk about economic indicators. Economic indicators provide insight into the current and future health of the economy, and they fall into 3 different categories. We have leading indicators that predict future activity, such as stock market performance, new home permits. We have lagging indicators that confirm past trends. So these are things that already happened, such as the unemployment rate. And then we have coincident indicators. So these move with the economy, such as looking at the GDP. So first, let's consider gross domestic product. GDP measures the total value of all goods and services produced in a country over a specific time period. Sometimes they talk about GDP in quarters, sometimes it's talked about on a yearly basis, but yes, it's one of the very common economic indicators that you'll hear people talk about. It's expressed as an annualized percentage of change. It can be adjusted for inflation, known as real GDP, or not. and this is known as nominal GDP. A rising GDP suggests growth, and a shrinking GDP signals recession. So why is this relevant? GDP is a key coincident indicator. That means it moves with the economy. Advisors use it to gauge overall economic momentum and to determine how portfolios should be positioned. Next, let's talk about a few employment indicators. So key measures include the unemployment rate. So this is the percentage of the labor force that is unemployed and seeking work. So it's important. It's both of those things. They're unemployed and they are seeking work. There's some people that are unemployed and are not seeking work. They don't count. Or there are many people who are not employed, but they're retired, or they are injured, they're disabled, and not seeking work either. We also have non-farm payroll, so monthly jobs data excluding agriculture, which is a major market mover. And then we have the labor force participation rate. So this is the percentage of people working or actively looking for work. So they're in either of those categories. They're gainfully employed or they're looking. So those two together, that creates the labor force participation rate. So why are these important? So these are lagging indicators, meaning they confirm trends. They look back at the past. Tight labor markets may lead to wage inflation and interest rate hikes. So it's important to look at those as well. Okay, then another thing you can look at are trade deficits. So the trade deficit occurs when a country imports more than it exports. If you reach a trade balance, that means that your imports... So the trade balance is your exports minus your imports. And if you have a deficit, it means that more money is leaving the country than coming in. So that could be another economic indicator there. And what's the impact of a trade deficit? So a trade deficit may weaken domestic currency, so the value of your currency can go down. It affects your GDP calculation when you're looking at your net exports, and it can influence foreign investment flows. So why is this important? So advisors should understand how trade balances impact currency value and international investments. Finally, let's consider the Consumer Price Index, also known just as the CPI. The CPI tracks the average change over time in the prices paid by consumers for a basket of goods and services. So they look at a bunch of common goods and services. Say you're looking at bread and eggs and milk and fuel and some other common services. And you put those all together, and that's your basket. And you monitor how much that basket of goods and services either goes up or goes down over time. This is a key inflation indicator. So if that basket is slowly rising, you can say, well, looks like inflation's going up. Core CPI excludes food and energy for a less volatile measure. So you might hear sometimes say the core CPI is this, and excludes food and energy. And this is also used to adjust Social Security and other government benefits. So you might say, well, it's a fixed income sort of thing. So if the CPI is going up, then we need to bump up some of these government benefits to keep pace with the CPI. So why does this matter? A rising CPI equals inflation pressures, possible interest rate hikes. And a falling CPI is a sign of deflation, possible easing by central banks as a result. All right, so that is a lot of good information. Let's go ahead and let you recap what we learned today, and then we'll give you some multiple choice and open answer questions so you can quiz yourself to make sure you are ready to move on. So today we expanded on critical macroeconomic tools and indicators. Inflation and deflation affect purchasing power, policy, and investment returns. Interest rates, yield curves, and credit spreads are powerful market signals that you should pay attention to. Economic indicators like GDP, CPI, employment, and trade balances help advisors assess economic conditions and guide client strategy. Understanding these concepts strengthens your ability to interpret the economic environment, And that's a core skill that is tested on the Series 65 exam. Which of the following best describes deflation? A, a rise in interest rates. B, a general decline in prices. C, a sharp increase in government spending. D, rising consumer demand. The answer is B, a general decline in prices. That's deflation. What typically happens to bond prices when interest rates rise? A, they increase. B, they remain unchanged. C, they decline. Or D, they become more volatile. The correct answer is C, they decline. It has an inverse relationship with this. What is one reason to take full-length practice exams? A, to memorize answers. B, to avoid using a study guide. C, to build test endurance and identify weak areas. Or D, to learn regulatory definitions only. So here the correct answer is C, to build test endurance and identify weak areas so that you can work on them in the future. All right, one last multiple choice question for this round. Which of the following is the most effective way to address weak areas in your study? A, skip them and focus on the strong areas. B, increase time spent reviewing those topics. C, avoid practice exams. Or D, study only on weekends. In this case, it's B. You want to increase the time spent reviewing those topics. An inverted yield curve is often interpreted as a sign of A, future inflation, B, a strong economy, C, a pending recession, or D, improving employment rates. The correct answer is C, a pending recession. It's not a good sign for your economy if you have an inverted yield curve. Which of the following is considered a leading economic indicator? A, GDP, B, CPI, C, non-farm payrolls, or D, building permits. The correct answer is D, building permits. That's a leading, it's forecasting into the future. So a lot of people are getting building permits. That's a good sign. People are going to go out and build. And people build most when the economy is looking good. They think they can expand, or they think they can sell these properties, whatever. What is the difference between a corporate bonds yield and a treasury bonds yield called? A, the nominal rate. B, the discount rate. C, the credit spread. Or D, the market premium. This is called C, the credit spread. So comparing the corporate bonds with the government bonds. All right, which economic indicator measures inflation at the consumer level? Is it A, GDP, B, PPI, C, CPI, or D, the Fed funds rate? In this case, it is C. It's CPI. It's that basket of goods that they look at and see, oh, are these going up? Are they going down? This is a very consumer level indicator of where the market is headed. Which of the following is true of a trade deficit? A, it means exports are greater than imports. B, it usually strengthens a country's currency. C, it can reduce GDP. Or D, it decreases the federal budget. In this case, it's C, it can reduce GDP because of the problem with more money going out than is coming in with goods. What does the Federal Reserve typically do in response to rising inflation? A. Reduce interest rates. B. Increase the money supply. C. Lower reserve requirements. Or D. Raise interest rates. In this case, they raise interest rates. They want to get money out of the economy because of inflation. Which of the following is a lagging economic indicator? A. Stock market performance. B. Unemployment rate. C. Retail sales. Or D. Manufacturing orders. In this case, it's that unemployment rate that looks back to the past that confirms trends in the market. You're able to look back and say, oh yeah, the unemployment rate was this. That jives with what we're seeing. Which phase of the business cycle is typically associated with rising interest rates and inflation concerns? Is it A, expansion, B, trough, C, contraction, or D, recession? In this case, the answer is A. That's when we're worried about rising interest rates and inflation. Which of the following is a tool of monetary policy? A. Corporate tax rates. B. Government spending on infrastructure. C. Open market relations. Or D. Trade tariffs. So monetary policy, open market relations is the only one that is a tool of monetary policy. A government increasing spending and cutting taxes is an example of A. Contractionary monetary policy, B. Expansionary fiscal policy, C. Expansionary monetary policy, or D. Tight fiscal policy. So here the answer is B, expansionary fiscal policy. So this is the government doing it. Who is primarily responsible for implementing monetary policy in the United States? Is it A, the Department of Commerce, B, the Federal Reserve, C, Congress, or D, the Internal Revenue Service? In this case, it's B, the Federal Reserve. They are responsible for all of those things. Which yield curve shape most often signals investor expectations of strong economic growth? Is it A, inverted, B, flat, C, normal or upward sloping, or D, concave? In this case, it's C, normal or upward sloping. That is what you'll see if the economy is going great. All right, so now I'm going to give you 3 open-ended questions and give you some sample responses to go with them to make sure that you're understanding some of these concepts on a deeper level. All right, the first is, why is it important for advisors to monitor CPI and other inflation indicators? So here's a sample response. So CPI affects interest rates, purchasing power, and the real return on investments. By monitoring inflation, advisors can adjust portfolios to hedge risk, such as adding tips or commodities during inflationary periods. How can yield curve analysis help in making investment decisions? So the shape of the yield curve signals future economic expectations. A steep curve suggests growth, favoring equities, while an inverted curve may prompt a shift to defensive assets or fixed income. And finally, what does a widening credit spread suggest about market conditions? So a widening credit spread indicates higher perceived risk in corporate debt markets. Investors may be moving towards safer assets like treasuries, signaling caution about the economy or specific sectors. All right, how did you do? If you're feeling good about things, it's time to move on to the next lesson. If not, you might want to go back and review what we talked about before moving on to the next lesson. So the next lesson is going to be financial reports and accounting fundamentals. So if you think you're ready to move on to that, go ahead. And that is all for our lesson for today. Thank you very much for listening.